The Atlanta Fed GDP tracker shows the U.S. economy is likely in a recession. This is the main headline here on CNBC. And according to this Fed GDP tracker, the U.S. GDP for Q2 is likely to come in at a negative 1% print. That would be 2 declining quarters of negative GDP. That would be a technical recession, and I think we are in for some more downside here in the markets. That's exactly why I put on some Tesla earnings trades. If you guys want access to all of my trades in real time, link down below in the description. But on top of all of that, we did get inflation reports out of Europe, and that was not so pretty. We need to talk about that, and the ISM manufacturing PMI that did come out today that is good and yet bad at the same time. So we got a lot to talk about. We're going to dive into AMC stock, what is happening for the day, something very interesting. You can see the short interest is estimated to be falling, and I want to go over why Ortex is estimating the short interest is falling in the way that it is, because it's clearly not falling like Ortex estimates. So we are going to dive into all of this key information. If you guys find value out of the video or want to help push this video out to as many people as possible, hit that like button and subscribe to the channel. Thank you guys for doing that, and now let's get straight into it. So indeed, it is not only you and me Americans that are feeling inflation in a massive way. Actually, the Eurozone just set a new high for inflation at 8.9% for the month of June, from 8.1% in May. So inflation is not going away, and inflation is really a sticky thing, because when people raise prices, they don't tend to cut prices until you actually get a recession. So typically inflation is cured from recessions. Usually recessions cure inflation, and that's why these two are going hand in hand. And the markets are really in a weird spot right now, where sometimes they fear a recession more, sometimes they fear inflation more. And like I just said, when a recession is the cure to inflation, the question then becomes how deep, how hard, and how long will this recession last? And that is the golden question that nobody can answer. But I think by and large, it might be a 6-month recession, it might be a year recession, but it's not a debt recession, so I don't think it will be a really bad one. Now, it all depends on the price of oil. That is the difference between a recession and a depression. You can pay $5 a gallon for gas all you want for a couple weeks, maybe a couple months, but if you're talking a couple years, that's really going to hurt the economy in a major way. And this Eurozone inflation news was not good, but Europe did still perform very well on the day relative to the bad news that they did get. Now, on another note, Atlanta Fed GDP tracker shows the U.S. economy is likely in a recession. The Atlanta's Fed GDP Now gauge sees the second quarter running at a negative 1%, coupled with the first quarter's decline of 1.6%. That would fit the technical definition of a recession. It says most Wall Street economists have been pointing to an increased chance of a negative growth trend, but figure it won't come until at least 2023. However, the Atlanta's Fed's GDP Now measure, which tracks economic data in real time and adjusts continuously, sees second quarter output contracting by 1%, coupled with the first quarter's decline of 1.6%. That would fit the technical definition of a recession. Quote, GDP Now has a strong track record, and the closer we get to July 28th's release of the initial Q2 GDP estimate, the more accurate it becomes, wrote Nicholas Colas, co-founder of Data Trek Research. The tracker took a fairly precipitous fall from its last estimate of 0.3% growth on June 27th. The data this week showing further weakness in consumer spending and inflation-adjusted domestic investment prompted the cut that put the April through June period into negative territory. One big change in the quarter has been rising interest rates. In an effort to curb surging inflation, the Fed has jacked up its benchmark borrowing rate by 1.5 percentage points since March, with more increases likely to come through the remainder of the year and perhaps into 2023. Fed officials have expressed optimism that they'll be able to tame inflation without sending the economy into a recession. However, Chair Jerome Powell earlier this week said getting inflation down is the paramount job now. So as long as, it sounds bad, as long as unemployment does not start to spike in a major way, as long as it stays low, then the Fed will continue to raise rates. The real question that you guys should be asking yourself is, over the last 2 years, we have increased GDP by over 5%. Well, do you think the Fed would be okay, say losing 2% or 3% to get inflation down? I think so, and that would be for a pretty decent recession overall. That would be a pretty big shit show, at least for a short amount of time, maybe a year. Relatively speaking, a year is a short amount of time. That would not be good, and I think that's the kind of situation we are in. I don't say this to spread fear or FUD, fear, uncertainty, and doubt, but it's what we're faced with. So I think that is, a very important thing to point out here on this channel. Now, on the crypto front, crypto billionaire Sam Bankman-Fried says more exchanges will fail. Quote, there are companies that are basically too far gone. And he goes on to say that third-party exchanges are already insolvent, a vast majority of them. And this comes after just yesterday, it was reported to CNBC that FTX is close to a deal to buy crypto lender BlockFi for roughly $25 million. That is down 99% from its earlier valuation of around $8 billion. So down 99%. That is a fire sale because BlockFi is indeed going bankrupt. And if Sam Bankman-Fried is correct, then a lot of other crypto hedge funds, crypto exchanges will also go bankrupt, and that could be a big thorn in the back of equity markets, because the question will become, is crypto just too far gone? How much pain will be felt in crypto? How much leverage was there to begin with? And how much is that actually going to feed into the stock market? Those are questions that we simply cannot answer as of right now, but we will get answers in the next coming months as the crypto winter has, in quotes, officially already started. Now, let's go ahead and take a look at AMC and what is happening here on the day. So AMC is having a relatively mild day relative to some of the moves that we can see with AMC stock, up or down 5-10%. That tends to happen quite often. AMC was positive for a good portion of the day today. Now we are hitting new daily lows, and you did see this momentum really for the first half an hour or so of trading today. The stock was up well over 3%. Well, now you're down 1%. But if we actually take a look at the technicals, it does not look all too bad. I did go ahead and draw this descending line of resistance and this ascending level of support, and we are coming very close to an important level. This orange line right here, this 50-day moving average as well, that is key because we want to see the stock hold support, which by and large it has been doing since we broke out above this 50-day moving average on June 27th. We have pretty much held support at this level. We have closed above this almost every single day. We're still above this right now, but in the beginning of the trading day, we actually broke above this descending level of resistance, and I think that is a very positive thing. If we can get a break above that and a close above that, if it's today, if it is on Tuesday when we start trading next week, whenever it is, that is going to be a very bullish sign, and that could give us the next leg for AMC stock. And we have been in a pretty decent overall uptrend, so as long as this can continue, we're going to see more volume come into the stock. We are going to see more of those market maker shorts that have to get de-hedged for, aka the market makers having to go out and buy stock because the puts are no longer in the money. Then we could get a pretty explosive move to the upside, and that is what I do expect here over the next couple of weeks. Just given what the chart is doing alone, it looks really, really good. It looks like a solid uptrend. So there is that. That's a little bit on the technical front. The RSI is at 52.14, so it's pretty close to that neutral level of 50, and the MACD is very bullish. So both of those indicators, very, very good. Volume for the day at about 21.5 million. Yesterday's volume at 25 million. Yes, we will be above that by the end of the day, but it does not look like this will be a crazy volume day. Maximum around 40 million for volume is really what I would expect. 35 million looks to be closer to that average volume that we usually see, right? A little bit on the higher end. Some days we're around 25, 27 million, but still a very low volume day comparatively to what we have seen over the past year with AMC stock. So there's a little bit on the technical front. If we look at the Ortex data, the estimated short interest of free float is sitting at 18.8%. I will tell you right now, these numbers are not correct. You have not seen the short interest go from almost 22% June 15th, now down to 18.8%, and all we have seen is a little bit of an uptrend. No. Shorts did not cover in that way. Now, what is likely happening is that we are seeing some shares that are being returned from the free flow out on loan, and Ortex is probably taking in those shares that are being returned that were out on loan, which was about 191.48 million shares as of 7 days ago, now at 153.56 million shares today. So a reduction of about 30 million or so, roughly, right? Or so shares that have been returned. They're probably assuming some of those were shorts covering, and that's why the estimated short interest of free float has been going down so much. But I will tell you right now, there is no indication that shorts have been covering. Now, cost of borrow rates are still very high. Even the cost to borrow right now, if you wanted to take out shares and lend them, short them into the markets, you can see right here 150,000 shares cost to borrow rate for right now, 14.39%. So not as good as what we were seeing yesterday, the 20% or so cost of borrow rates, but still very, very high. Cost of borrow minimum says right here 15.41%, cost of borrow average of 18.06%, cost of borrow max of 27.2%. These numbers are going to be very volatile, but the fact that they are staying up for so long, especially that cost of borrow minimum, is definitely a good thing. Now, you are seeing a lot of bullish option activity coming through for AMC stock as well. Look at these July 15th $13 calls. This is a $262,000 order with a break even of $14.50 per share. So that would be about a 15% move to the upside here before July 15th, or this hedge fund will lose $262,000, which hedge funds let me tell you right now, they can't afford to be losing $250,000 just based off of a random trade for AMC stock. And it looks like the same hedge fund also put in a $13 call expiring today for $129.2 thousand with a break even of $13.74 per share. So I think this is what helped cause that initial move to the upside once we started trading for the day. But you have seen some puts start to come through, and you're probably going to see more puts start to come through throughout the rest of the day, and that might actually help us to go down a little bit. So there is that. The interesting flow sentiment has us at 6 orders totaling $819.41 thousand, positive order value of 91%. So I think things look really good in that regard as well. Positive order value of 91% is definitely not something to sneeze at. Now, let's go ahead and take a look at the option activity in the Max Pain throughout the rest of today, and then we will go ahead and wrap up this video. So for today, you do have calls in the money of about 19,000 calls that are out of the money, 141,000. For July 15th, you do have 26,535 thousand calls that are currently in the money, 461,000 calls that are out of the money for July 15th. So that is going to be a very bullish event in my personal opinion. You have such a large ratio of calls that are out of the money compared to calls that are in the money. I think there's no choice but to see somewhat of a bullish reaction around that expiration. You also do have about 88,000 puts that are currently in the money, and that, like I said, when the stock price goes up, puts go out of the money. Market makers have to go out and buy stock because they had to short stock to oblige for all the puts that were in the money. If they are no longer in the money, if they start to move, out of the money, if the stock price starts to go up, calls go into the money, puts go out of the money. That is 2 forms of buying pressure. And when you have 88,000 puts that are in the money on that July 15th expiration and 461,000 calls that are out of the money, if you do see a move to the upside, that can be a very, very bullish scenario. And the Max Pain for today, sitting at $13 per share. So that is roughly where we are sitting at right now, and looks like the market makers are going to cash out, because that's pretty much where we're sitting at right now. So that is going to be all for this video. Hit that like button and subscribe to the channel if you guys did find value out of the video. As well as that, get your free stock down below in the description with Webull, Moomoo, and Public. And if you guys want to come trade with me live in real time, link down below in the description as well. Thank you guys for watching. I will see you in the next one.